thanks everybody for coming this evening to this webinar. Just a little bit about myself. I'm a graduate I'm a graduate of the University of Pennsylvania, and I'm a former full-time professor at Jefferson University, which is also in Philadelphia. And I've published many articles. I became involved in the financial markets over 20 years ago. So excuse me for 1 second. Hello. I am. Oh, my mic is off. Oh, okay. Okay, I'll get it going. Okay, I'm sorry. I am here. Can everybody see my screen okay? Can you see the slides? Okay, good. Sorry, I was talking with my microphone off, which is never a great idea. I want to thank everybody for coming, and I really want to thank Kevin for the introduction. And just a little bit about myself. I'm a graduate of the University of Pennsylvania, and I'm a former professor, full-time professor at Jefferson University in Philadelphia. And I've been involved in the financial markets for over 20 years, and I began trading the futures and Forex markets about 10 years ago. Now, my thesis was about the optimization of multivariable equations, which I applied to the optimization of software systems that try to increase the predictive value of a trading entry via mathematical modeling. So none of the indicators that we put into our platform are simply there ad hoc. We have already determined and defined that each one of them has a purpose, and each one of them via mathematical modeling increases the positive predictive value of getting a successful trade. And one of the questions I always ask when I'm at other people's webinars is, what is the positive predictive value of your trading entry? Like, what is the sensitivity and what is the specificity of that blue dot long or that red dot short? And nobody can ever answer the question. And if you can't answer that question, then you simply do not understand the predictive value of your own software. Now, we're at www.rightline Trading. And what I wanted to talk today was really about the Forex markets. And for some reason, they really have not caught on to any significant degree here in the United States. I mean, they are the rage in Asia, and for the most part in Europe, and also obviously in China. These are very, very, very heavily traded markets. And most of the scams that you see with the Forex engines that make you 100,000 pips are usually targeted to the Forex because the Forex has universal appeal. And it's the kind of system that can be marketed worldwide. I mean, there are much fewer participants in the gold market, in the crude market, in the E-mini S&P market than there are worldwide in the Forex markets. So if somebody's going to create one of these instant profit Forex instant profit engines, they're going to do it on the Forex markets. And I'm going to show you how easy they are to trade if you understand a little bit about market movement, how lucrative they can be, and how you can make them your primary market of choice to trade, or if you're on the East Coast, you can get up late, which is what I do, and grab 20 to 30 to 40 pips and make a really decent amount of money, go back to sleep, and wake up in profit for the day before you start trading, say, the E-mini or the Russell or the NASDAQ or gold or crude. Now, some of the features of the Forex markets that make them more easily tradable than most of the markets that are based here in the United States, like the CME, the NYMEX. The COMEX is obviously market size. And with market size comes incredible liquidity. Now, it's easy to get into a trade, and it's easy to get out of a trade. And the thing well, you're going to see, I don't have my staff here. I'm here alone, so it's hard for me to answer questions inter-trade. You're going to see, inter-talk, but you're going to see that most of our trades go quite a distance. They go 20 or 30 pips, and I'm going to move you from slides to our platform and show you our trading entries. They are clear cut, and even though they're retrospective in nature, you're going to see how they keep coming up, and it's basically the same pattern. We don't go for 2 or 3 or 4 pips. So what you have is a market that is extremely liquid. Now, moving in and out of it is easy, or easier. You get less slippage, and you have less problems getting out at your stop. You get in easier, and you get out easier. The other thing is, I've traded the 6E, and the 6E is a very, very manipulated market. I'm going to show you one of our indicators, and even though we're on a range chart, it shows contracts traded per minute. And the 6E will all of a sudden make this impulse move of 25 ticks on massive volume, and then just drop off to 100 or 125 contracts a minute. And you see the institutions move in and move out of the 6E, and it's really, really aggravating, because you can't trade those moves. They don't come with market sentiment. They come with a single institution's sentiment. Now, as I mentioned, ease of entry is one of the parameters associated with this massive liquidity. And the other thing is that you get a tremendous amount of leverage. Now, remember, leverage works both ways. It can make you money fast, and it can lose you money fast. But you can get up to 1 to 100 leverage on your dollar. $1,000 can control $100,000 worth of currency pairs. So you have the ability, with a very small initial portfolio, with an investment of $500 or $750 or $1,000, to make an enormous amount of money. And that's where the potential profit comes in. If you could trade the Forex lucratively and do it with consistency, you don't have to do it with a lot of money. Now, it also has tax advantages, believe it or not. When you trade an American futures market, all of the money you make is taxed at the short-term rate, which is almost 40%. On the Forex, only your first 40% of profits taxed at 40%, and then the rest is taxed at 15%. So if you make a significant amount of profit, you wind up paying less taxes. Now, the trading hours are great because it trades 24/7, but what we really want to do is take advantage of the trading hours when most of the volume crosses. Those are obviously the most liquid periods of time, but you can trade it 24/7 if you want to. Now, remember, there's no commissions. You don't pay for round trips here. There's a bid and an ask, so you pay a spread. Now, when the market is very lucrative, or when there's a lot of contracts crossing, the difference between the bid and ask can be as small as a pip. Now, the value of a pip is determined by the number of lots you're trading. So you have a little bit of lingo to learn if you want to trade the Forex, which is something that I would teach you. But you don't trade it in contracts, you trade it in lots. And you can control a huge number of lots on a small amount of money, and what you pay is the difference between the bid and the ask. Now, as I already mentioned, you have a tremendous amount of leverage. I mean, the leverage is almost scary, and if you're a very successful trader, you can make a lot of money on a very, very small initial donation to your account. And I put in guaranteed stops, but what I really meant to say, and what may be a little bit more accurate, is it's not uncommon when you're trading a fast-moving market here in the United States. If you put in for, say, a 10-tick stop, you wind up getting a stop at 11 ticks or 12 ticks. You take 2 ticks of slippage. That's very, very rare on the Forex. If you're trading during periods of time where the market is liquid, you are very, very rarely going to wind up with any slippage. Now let me just move this down a second here. Now I just really want to just familiarize you a little bit with our philosophy about trading. Now there are 3 types of there are really 2 basic underlying strategies that software developers take when developing a program to define market direction. And there's traders that just trade price action, and they study price action. You know, these are the candlestick guys, and they believe that price action alone is going to give you the sensitivity, specificity, and positive predictive value high enough to provide you with profit. Then there's the indicator analysis group of people. And what they rely on is some unique composition of the indicator signals, simply a confluence of indicator signals. And these are the blue dot, red dot guys. And these guys are going to take you long on a blue dot and take you short on a red dot. Some of these are black box systems. A lot of them are open systems. But they're basically based on a confluence of indicator signals hitting, getting you into a trade, and that trade being successful with enough precision and enough consistency to make you profitable. And you're not going to find that anywhere. There's no blue dot, red dot system that works. If it did, you could robot trade the markets for a fortune. And we have 3 auto traders, 4 actually, and they do give you a nice return on investment, but they are very difficult because indicator analysis is just inadequate. And if anything, if you have to look at price action and indicator analysis, price action is far more powerful. And then you can divide these 2 up into one group that trade one time frame and those that trade higher time frames to confirm the validity of their entries. And we always want to trade multiple time frames. The problem is that it's cumbersome, but it's something that needs to be done. So really what I said was price does not provide you with low risk, high predictive value entries. Neither does any confluence of indicator signals. And like I said, if either did, you'd be able to trade the markets for an enormous amount of profit. So what we've done at Rightline is to create a system that combines market structure, which is simply price action, with indicator analysis. And what we rely heavily on is fractal analysis. And that is all of our indicators assimilate data from multiple time frames and project that information onto your trading chart so you don't have to look at multiple time frames. We even do that. I think we're the only platform that does that with market structure. We make an assessment of market structure on multiple time frames and project that onto our trading chart as well. You want to make sure that you're trading with the longer term trends, and that's price action. And you're going to see that we define those trends easily in an intuitive way for you so that you can optimize your trading to only trade during the best periods of time. You want to trade during a trending market. And a trending market, in my opinion, is when the trend on your trading chart corresponds to the trend on higher time frames. And that's what we look at, are 2 higher time frames. When that happens, you're going to see that magic occurs, and you'll wind up with a lot of winning trades. Now, as part of our methodology, we do not call tops or bottoms. We do not trade reversals. We do not counter trend trade. We do not try and predict breakouts. We are trend traders only. We believe that institutional traders set the trend. We want to be on board with them. And it's our goal to define a trend early and get on board fast. Well, we want to get in on a move safely. Because we don't believe that any indicator confluence, if the trade goes 5 ticks, is going to guarantee that it's going to go a 6th. So what we do is we have to get in on a conservative pullback. And I'll show you exactly how that works. I just want to quickly define some of the things that we do. This is a 50-period simple moving average. And we believe that when price is above the 50, the bulls are in control, and that's the only time we go long. When price is below the 50, the bears are in control, and we only go short. But remember, this is defining price action on one time frame, and that single time frame is not enough. We also believe that the distance between the candle open and support or resistance is a significant independent variable. So we have an indicator that tells you how far away the candle open is from the area of support or resistance. And that's a very, very important parameter. In other words, what we've tried to do is define every independent variable associated with taking a successful trade and then optimize the parameters we use to trade that variable. Now, we look at order flow, stochastic, and momentum, but we do it on multiple time frames. Everything done is done on a fractal analysis basis. We just don't look at order flow on our charting time frame. We look at 2 higher time frames as well, stochastic direction and momentum direction as well. And we project this onto the price bars in a way that makes it very, very simple to comprehend. Now, what I want to do is basically go over to the charts. So just give me 1 second, and I'm going to move my PowerPoint out, and I want to move my charts in. And I may have to reshoot the chart. I'm not sure, but let me get a chart in there if I can find it. Okay. Now, can you see that chart? Or should I reshoot the screen? Can everybody see that chart okay? Can you see that? Okay, all right, it just came through. You know what? I'm just going to make it bigger. So hang on 1 second. Let me make it larger, and I'm going to reshoot for a larger screen. All right, hang on 1 sec. Okay. Now everybody should be able to see that. Now this is the euro dollar. Now the Forex markets open at 3 a.m. Eastern Time. We always trade them on a 5 range. And what I want to show you, and I want to take a lot of the indicators out because I want to hone down on just a couple of things here and start with the basics. Okay, great. Thank you. Okay. Now, this is a simplified chart. And let me put in the one indicator that I want to show you and make sure that it works. Okay. Now, what you're looking at now is the fractal analysis of direction. When the background of these charts is the darkest green, that means that you have the two higher time frames also moving to the upside. It moves that your two higher time frames have the 15, or modified 15, moving to the upside. It means that your two higher time frames have the 50 moving to the upside. It also means that you have broken all resistance to the upside. It's broken through everything. So this is the strongest area to take a long trade, and that is during this dark green period. So if we take off all these lines, what we've done, in essence, is without you having to look on a 5 range, we look at an 8 range, and we look at a 13 range, is to find when the best time is to go long. Now the blue, I don't want to get, for webinar purposes and without confusion, there are two other up colors that are not as strong here. There's the blue, and then there's one that we don't see that often. There's this magenta, or that might be cyan. Now these are weaker. This is your strongest color, right here. Now what makes this so powerful and so important is that the colored background, and these are the kind of indicators that you can look at in retrospect, and the power that you see in them is the same as a live chart, because they are not affected by any price action on this chart. They are only affected by price action on the 8 and 13 range. So if price goes up during this dark green, it doesn't affect the color. In other words, if you look at it stochastic on one chart, every time price goes up, the stochastic goes up. If you look at the MACD, every time price goes up, well, the MACD goes up, because price is driving the indicator rather than the indicator driving price. Here, this background is unaffected by price action. Those are the kind of indicators you want to be looking at. And here is where you always get your great move for some reason. I see it day after day after day on the Forex. The market opens at 3 a.m. Eastern, and we don't have any other indicators here. But here's your move down, and here's your retracement, and you've got the darkest color, so you know that the 50 and the 15 and price action are down on your two higher time frames, and the chance of this failing is really, really small. And you get your first trade to the downside, which goes 13 pips. Now, depending upon your ATM strategy, if you're out on a reversal, here's your second entry. Nothing's changed. And you're in one tick below, and here's 12 pips. Same thing. Move up, continuation trade, and that's your third entry. Now, once you take 3 pullbacks, the 4th pullback is the weakest. So you don't want to push it. So of these moves, you get 13 pips, 12 pips, and 8 pips. That's a total of 33 pips on that move. Now, depending upon how many lots that you're trading, that's a very, very lucrative move. And that's it for you on the Forex. You don't have to trade it any further if you don't want to make the Forex your primary chart. And these moves happen most commonly during this period of time, between 3 and 4 o'clock in the morning Eastern. Now, if we go through the day, you'll see that here's a nice move to the upside. It comes with background bias, and it's a small move, but it's a winner. We're always trading, and here's this unbelievable move up. We can take the trade because we know it's a retracement to the modified 15, and multiple time frames are heading up, and up we go. Now, this also is applicable to what we trade: gold, crude, the ES. It's all the same. But the fact is that these are very liquid markets, and during this period of time, the difference between the bid and the ask is small. And when the currency pairs start to trend, and we know they're going to start to trend when we hit that dark green, that's when you look for the retracement and the move up. Now you see, when there's no background bias, it means that there's no correlation between the direction of your trading chart and the direction of the 2 higher time frames. So you just ignore this. This is really the ultimate definition of chop. When your direction on your trading chart doesn't correspond to your 2 higher time frames. And here it starts again. Dark, and remember, none of this is occurring based on the color, based on price action on these charts. You have a move up here. If you don't hit your target, you pull back, but you don't get close to getting stopped out. Depending on your ATM, you get a pullback. You may not get close to getting stopped out. It all depends on how aggressive. But you've got a move that potentially can take you all the way up to the top. You just have to wait for the time frames to align and to get in on a trade directly off of support. And that's a 24 pip move. Now I want to show you a different market. Before that, let me add a couple of more indicators in. I want to show you a very, very unique indicator we have that I don't believe anybody else on the planetoid honestly has it. And we've spent an enormous amount of time working on it. Just let me bring it down here. Now this is... All right, let me hit OK. Now hold on one second. I'm on the wrong chart. I'm sorry. Okay. Now let me just hit apply and we're good. Okay, now here is where the 2 higher time frames, here's how the higher time frames work. If you trade a range chart or a tick chart, it's going to default to the closest fib. So let's say you trade a 4 range. Well, the software is going to define you as trading a 5 range, because a 5 is a fib number. And then it's going to give you the next 2 higher fibs. So you have a 5 range, your next highest time frame is an 8, your next highest time frame is a 13. Let's say you trade a 350 tick chart. It's going to default to the 377 tick chart. And then it's going to give you your 2 higher time frames. I think it's 610 and I can't remember what it is. It's 610 plus 377. It's going to be like 1,000 or 1,100. So it defaults to those. If you trade a time chart, it's going to default to your first higher time frame is going to be 3 times your first. Your second is going to be 3 times your second. So it doesn't make any difference whether you trade, no matter what your range is, what your tick is, what your time is, and it also works with Renko bars. It simply does the same thing. If you're trading a 3-range Renko, it's going to default, or a 4-range Renko, it's going to default to the next highest fib. That's all it really is. Now what we've done is we've created what we call the quantitative analysis of correlative markets. Now we've built only 3 lines for the Forex so far, but we're in the process of building many, many more. And if you come aboard and you want a specific line built, we'll build it for you. Now what the correlative markets do is there are certain markets, when the Euro USD goes up, they either go up with it with a correlation coefficient of 0.7 or greater, or they fall with a correlation coefficient of 0.7 or greater. So these markets move in tandem, either with or against, with a very high correlation coefficient. No problem. So when you have correlative markets that are yellow, that's a great time not to trade. What we're trying to do is further define for you. First, we define it with multiple time frame analysis of direction and price action. Now we're defining the directional or the trend in terms of how your correlative markets are behaving. Because on an up move, it's very likely that the correlative markets are going to be green. And in a down move, it's very likely that the correlative markets are going to be red. And the reason is this. It's money flow. When money is flowing into the euro dollar, we know the correlative markets that go up are also going to pull money into them. And we know that the correlative markets that go down, people are going to be pulling money out of. So that's what this line does. And it increases the specificity of your trading tremendously. So that let's say you get a really nice trade like this, but the quant line, as we call them, or the quantitative analysis of correlative markets is yellow. That tells you you can still take the trade if you want to, but what the goal of our platform is to define risk. And the risk simply is greater. Now, on a yellow quant line like this, with essentially no bias, you know to stay away. Now, when it's green, you're always looking for an up move, but you want that background bias. And when you get them both, like here, like here, like here, like here, the predictive value of a successful trade is immensely high. And the other thing that makes this line so powerful, just like background bias, is it is not affected by anything that happens on the chart. In fact, it isn't even affected by anything that happens on the Euro USD. These are all other markets it's assessing. So that's a very, very powerful line, and even looking at this line in retrospect, and that's a big red herring. When somebody shows you an indicator that analyzes price movement on the trading chart, it always looks good in retrospect. It looks remarkable. Then when you trade it in real time, you see all the false moves it generates, where it's curved up and then the candle bends down, and you're faked out and you're in a loser. Well, this can't happen. This is going to be red just like this, no matter what this price does. It's not falling because this line is red. All this red line is telling you is that the correlative markets that should go up or could go down are losing money, and the correlative markets that we know are going to go up are gaining money, and we get the red line. So it's very helpful to trade with it. And if we go to another day, now this is not just for the Forex. We use this on everything, and I'm going to show you. I'm going to add this indicator right now because this is such a great indicator that I have to show it to you because it's a market structure based indicator. It's called our consolidation indicator. Now, do you see the red and the blue line? Well, that defines a period of consolidation. And for me, consolidation is immensely powerful because during a period of consolidation, it tells you that two things have happened. One, volatility has dropped. I mean, there's no volatility here. And two, the bears and the bulls have equal power. That's a very narrow channel, and I love it when they keep exchanging color. Now, if you had to make a guess which way price was going to break out of consolidation, when you have a green quantitative analysis of correlative markets line and a green background bias line telling you that price is heading to the upside on two higher time frames, you are going to pull a long. And the long is going to be right here. And it's the same thing here. You get sideways, and this is created in real time. It prints on the fourth candle with an audible alert. And up you go again. This doesn't quite make it, but you can see how the market is consolidating here. And how it lifts off. And I consider this to be like a reloading of the market. People talk about the market being overbought and oversold. And eventually, you have to be careful as you start getting really high up. But every move out of consolidation is almost always going to be to the upside until you get markedly overbought. And that is our consolidation indicator. And you see it works here, and you can take a long. But this is more of a cautious move. You can see this is not our strongest up color, and the quant line is yellow. It means the correlative markets are not moving. They're moving sideways. They're not moving against the trade. And you can take this trade as long as you understand it's associated with increased risk. That's all. The platform defines risk for you. And that's what you need a piece of software to do. You can see how easily risk is defined here. Now we move down, and this is where we have the quant line, but we don't have background bias. You want to take a short trade here, you can. But again, you have increased risk. What we have to understand as day traders, and I read an article about this recently, is that you have to learn to let trade setups go that don't meet your entry criteria. If you're going to trade with specificity, you're going to have winning trades that you can't take. There's your trade to the downside. Consolidates right into resistance, and down it goes. That's why I love this indicator so much. Because when you take a trade out of consolidation with bias and with the quant line, you're almost guaranteed a winner. And day trading is never about the number of winners. It's always about the number of losers. That's really the key to day trading. You can have 7, 10 winners, but if you pull in 2 or 3 losers, you're going to wind up with a lousy day. What you want to do is trade with as much specificity as you can. Now let's add another indicator. Let's add, because everything that I add is simply going to increase the specificity of the way we trade. All right, already added in the MA diff. All right, this I want to add in here. Contracts per time. So we have a lot of indicators we don't use because we did not find that they increased the predictive value that we trade with. And what I'm going to do is I'm going to put in the ABC indicator. If I can find it. Here it is. ABC indicator. Now let's add these two in. Okay. Now the chart's a little more complicated, but it's still the same as it always was. Now let me just make the A, B, and the C bigger. And that'll just take me 1 second. This says 8. Let me try 12 here. Okay, now it's a little bit bigger. Now what we've done, now if you go to the right edge, and this is really an important indicator. I'm sorry, I just have to go to. I'm rebuilding the chart, but I want to do it in. I want to do it in pieces so that you get a feel for how we trade. Like in the morning, it's very, very easy for me to get 20 or 30 pips. The toughest part of it is for me to get up. But if I can get up and then still be available in the morning to trade the room, I'm good. Now, you'll notice that on the right side, this is a very, very actually complex indicator because that 30 is telling you the number of contracts that are crossing per minute. And it's telling you that on a range chart. And was very difficult for us because we don't care how many contracts occur in a range bar. Sometimes these range bars sit for 15 minutes and don't move. So they collect a huge amount of volume. To us, that's irrelevant. What we want to see is how many contracts cross per minute. The number behind it, and there was no way based on the coding of the platform we could move it, is simply the average volume based upon the range bars. And that number to us is irrelevant. Now, the reason that the volume indicator here is always 0 is because there are no sessions in the Forex. So what we do is we trade per session. Oh, absolutely. I mean, I look at these heavily on the futures market, and I see, like, if I'm trading, we used to trade the Russell, and it's crossing like 40 contracts a minute. Don't take that trade because there's no volume behind the move. Now, right now, you can see, the euro dollar is crossing 28 contracts a minute so far. We'd never trade that with that low of a volume. So it's a very, very nice indicator to watch. And the thing that it really shows you is when, say, crude oil is trading, say, 300 contracts a minute, then all of a sudden it makes a big move and it's trading 1,000 or 2,000 a minute. You know that the institutions have stepped in and they have tripled, quadrupled, quintupled the number of contracts, and they're going to take it. They do that on the ES constantly. Now, I just wanted to show you our ABC indicator. Now, right here is a great trade on our ABC. Now, you can see that I don't create the A and the B and the C. What we're simply looking to do and continually do is to decrease the risk associated with the trade, increased precision, increased predictive value. Now, I just want to tell you one thing that I don't want to run overboard. That's kind of extraneous, but relevant from a mathematical standpoint. One, the problem is that there's way too many people selling software who don't treat trading as a science, and this is a science. And the other thing is that because they can't tell you sensitivity, specificity, positive predictive value, and actually positive predictive value is sensitivity over specificity, but it's multiplied by prevalence. And when are you most likely to get a trade? Is during a trending market. That's when the prevalence of a retracement and continuation is most likely to occur. Now, let me tell you what is really great about the C's. You know something? We have a coder here who has a PhD, and I don't know where he pulls this data from. Today's one of the few days, he hasn't been out for a year and a half, but he had a problem with his mom today. He's a young guy, just finished his PhD, so I can't tell you where it's pulling this data from, but it's very accurate. And if you time it every 60 seconds, it's going to reset. It's only going to go 60, and then it's going to go back to 0. Now what you see on the C is people trying to call tops. Everybody in this B candle, and I just simply choose by default to color it magenta. You don't have to color it anything you like, but you also get an audible alert when a C flashes to tell you that there's a potential for this candle to engulf everybody in B. And what pushes these trades up is not only the fact that you have the quant line and the quantitative movement of the correlative markets are in your direction, that 2 higher time frames are moving up, but you have a third force now, and that is everyone in B is starting to get stopped out. Remember, they're short. And these are the unfortunates that have been taught to counter trend trade, call tops, and we exploit them by having a candle engulf them, which shows the tremendous amount of conviction of the buyers, and the push up is based on 3 separate forces: the quant, correlative markets, the trend, the fact that there's no resistance to the upside, and the fact that we're stopping all these people out. And if we just wait, there's a consolidation short, as I showed you. Now, when we're not on the right edge, this number's not accurate. It only reads on the right edge. Now, let me just show you one other really important indicator, because I don't want to run over. It's market profile. For a long time, we traded without it. And all of a sudden, we found it became incredibly relevant. And I don't know why, but we built our own market profile indicator. It is a superlative market profile indicator. We built it from scratch, and in looking at a lot of open-coded market profile indicators, we saw how bad they were. The point of control is where is the tick value or the pip value here where most volume is. And I can show you really quickly. I turn this off because we're not really market profile traders. What we are is we use market profile as an adjuvant indicator to keep us out of trouble. But you can see on the right edge here, that's the histogram. And we can make the histogram as big or as small as we like. We just chose to make it small, but we wanted it to be present. This tick value right here, that's got the most, or pip value, has the most volume, so this is the point of control. This is the value area high, that brackets the value area low, and within these 2 areas is where all 70% of volume that's crossed sits. And these areas act as tremendous areas of support and resistance. Like this area consolidation, sits right below the value area high. Eventually it breaks through. But you have to respect these areas and not trade into them. I wish I wish it was that easy, but when you get a great trade, like I showed you, let me find it. Let me find the really good one at 3 o'clock in the morning. Right here, you can see that's a problem because there's your value area high. You have to decide whether you want to trade into it or not. This one isn't an issue. You're above the value area high, and you still have a long way to go. So we stay away from value area highs, value area lows, point of control. If it breaks the value area high, retraces back to the value area high, everything stays the way it is, we take a long trade. So these are just all additional indicators to help us define market structure, to help us define trend, and this is much more powerful than the pivots. We do have a pivot indicator that we use with a very low sensitivity. It only shows the high pivot and the low pivot of the day. That's it. Everything else is defined by, all support and resistance is defined by market profile. And I wanted to see if there was anything else. And then I'm just going to bring in a couple of other markets, and I'll show you those. Because you really should trade the Forex. And I'm going to, because you really can make a lot of money. There's really not much else. I mean, what I'm gonna do is I'm gonna take this out. I'm gonna plug in the entire Forex template. So this is everything that there is. And it's not a whole lot different, except it does have these major pivots. And the pivots I'm not so concerned about as I am about market profile. Now let me show you a different market. Let's take a look at the Euro Yen. Go. Oh, okay, I didn't know I lost it, but I'm glad we've got it back. Now here's the Euro Yen. And let's go to the morning. And I'm telling you, this is not just. Now this is a tough trade right here. Well, it's right below the quant line. I mean, it's right below the value area low, but you don't have the quant. So that makes it a little tougher trade. Remember, you don't want to trade. Now here's a great trade right here. You've got the quant, you've got background bias, and you're trading off the point of control that's acting as support. So this is a great trade to the upside. You're going to get these throughout the session. Now we have to go to the right edge to see where the point of control is and where the value areas are because they are dynamic. There's another trade right here. It's a move down, it's a retracement, and it's a continuation trade. That's the second most powerful colored background bias. And your quant line is red. It's going to suck this trade down. So it's really just a matter of patience. Let me quickly go to the last market I have here. Let me just find it. Here it is. Whoops, that's not it. Oh, here it is. It's the Euro Pound. Now, each of these has separate quant lines because the correlative markets for the Euro Pound are different than the correlative markets on the Euro Yen and the Euro Dollar. Let's wait for some background bias to kick in Right now we don't have anything. And here's our trade, right here. It takes a little while to see them, but there's the move up, the retracement right back to support, with everything going for you, so that the continuation is very likely. Here, same thing. Look at that. This is a C candle. Look at that C. There's the move up. It's sitting right on the value area high. And man, it blasts right off. And you get a huge winner. Now, this would be tough to take because it's into the value area high here. That's a value area low. But it still works. It doesn't matter, though. It doesn't meet our specifications. So that's really it. What I want you to see is the platform defines risk. And in addition, you get great moves in the early morning hours off of the Forex markets. And once it starts to trend, you can really milk it for a lot of profit. Once you get this green background and the quant line turns green, and you start getting a trending euro pound or euro yen or euro dollar, you can milk this market for a lot of winners. And really, I mean, you can make $400 or $500 on a very small amount of money. Now, I just want to see if there are any other questions. Yeah, 5 range sigma for all of the Forex markets. We've looked at different ones. 5 range is the best. Listen, if you want, you can trade it with Renko, you can trade it with time, you can trade it with tick, but I've seen nothing that works better to me than a 5 range, although you're open to do anything that you want. But it's a very, very lucrative market, and I just want to show you quickly the special that we're running. And I'll put a link in if I can find it. Hold on one second here. Let me just drag this over. I think you should be seeing that. Now, the software is specially tweaked for the Forex, and in addition, we will give you, if there's a Forex market that you like, we will create that quant line, the quantitative analysis of multiple correlative markets for you. And I put 6 hours of personal mentorship time, but I'll even increase that to 8. What I want to do is I want you to learn how to trade the Forex. And I'm going to teach you how to trade the Forex. So I'm not just selling you a piece of software. What I'm doing is I'm selling you a significant amount of my own time to teach you the nuance of the Forex, to teach you how to set up your program from soup to nuts and get you profitable on the Forex markets. I mean, that is my goal here. Not just to leave you with a piece of software and then let you fly off into the sunset. Now, if you want to learn how to trade Forex and you do already have the software, we will provide you with the Forex program, and I'll sit with you for a significant period of time for a very, very inexpensive. I will teach you how to trade the Forex. But here's the link if you want it. Let me see if I can put it into the room. And this is that price divided into 3 installments. It's right there. And that's a PayPal link. And you have my guarantee that you're going to be a profitable Forex trader when you finish this program, unless you just are clueless. I'm going to teach you how to trade the Forex. It is not difficult, and it's a great market to trade, and you can open up an account with a very, very small amount of money. And I'm going to sit with you and personally mentor you through all the nuance of it. So that's the end of my presentation. We'll keep that link active for about 2 days. The normal price is just under $4,000. We're giving you $500 off, and normally I do not spend that kind of time. We really let you do it based on your based on our videos, because we have extensive video training. But I'm going to spend the time with you here. So listen, everyone. If there are no other questions, okay. To the chat. I did put it into the chat, Kathy, I thought. Right here. Is that the chat? Okay. All right, great. All right, well, listen, everyone. Have a great evening. I hope to see you on the program. And I'm telling you, together we can make a lot of money on the Forex. It's a great market to trade. So everyone have a great evening. Kathy, thank you. Kevin, I thank you again. And I thank everyone in the room for giving me their time. Let me just give you my phone number, which I didn't do here. It's 1. Thank you, Kevin. Just let me write my phone number down, 855-765-6681. If you want to call me, you can call us anytime. We're here almost all day, and I'll be here for a while this evening. So everyone have a great evening. Thank you, Kevin. Take care, all. Bye-bye.